Hello and welcome to this wide debate on the role of structured products and absolute return funds in market volatility. The markets over the past year have given investors no easy ride, with events such as the fallout from China's slowdown and the looming EU referendum creating volatile markets. But how can investors navigate these markets and seek stable returns amid the yo-yoing? And can structured products and absolute return funds play a role in achieving these returns? To answer these questions, I'm joined by Jason Barron, an insight analyst at De Facto, Alistair Cunningham, Financial Planning Director at Wingate Financial Planning, Colin Brockman, Head of Retail Distribution for Structured Equity Derivatives at Investec Bank, and Anthony Villas, Managing Partner at First Wealth. We're streaming this debate live, so if you have any questions for the panel, please use the tweet using the hashtag MMWired. So, Alistair, looking at the market volatility, what have you seen being the causes for that over the past year?
If we look globally, obviously the Chinese situation, late July moving into August was a huge impact, affecting all our client portfolios across the board. To a large extent, the EU referendum is a bit of a red herring because most investors will be diversified away from it solely being in the UK, but I think probably it's suppressed returns more than increased volatility.
And so how have you seen the reaction from clients, Anthony? What have they been saying to you amid this?
I think generally clients are more okay with volatility since the financial crisis of 2008. Well, that said, big movements, sort of something like January, people will ask the questions about what's going on. But I think investment companies and financial planners are better at explaining the way the portfolios are mixed in terms of asset classes anyway. So people are more aware of what's going on, so maybe less need to be concerned during volatile periods.
And so in terms of the products that you've been recommending, how has that changed over the past year and where have you kind of been looking?
I don't think it's changed massively in the last sort of year. I mean, we're independent financial planners essentially, so we are able to access a wide range of products. So we look at investment accounts, structured products, private equity type of investments, even some of the sort of the old approved investment bonds, that type of product. So gives us a diverse portfolio that hopefully can generate positive returns in different market conditions. So that's sort of been our mainstay for the since we set up the business, really.
Right. And Colin, amid this volatility, you guys would make the case that structured products really have a place to navigate that and provide stable returns. Have you seen a pickup in interest for those products?
We have, actually. What you tend to find is that when the markets rise, appetite for structured products which have an sort of inherent inbuilt sort of protection factor, the appetite for those seems to reduce, and when markets fall or are very uncertain, as we currently have at the moment, then the appetite increases because people become more fearful and therefore are looking at trying to protect their portfolios.
Mm-hmm. And so has that been the case for absolute return products as well, which also have that defensive nature to them?
Well, certainly absolute return products their mandate is to produce, sort of cash plus 3%, 4%, or 5% per annum on a sort of a 3-year rolling basis, and over longer periods of time certainly can achieve absolute returns. What we've noticed, perhaps, if we look at say 2015, where we had a large upswing in the market up to above 7,100, and then falling back down to just over 5.5 on our FTSE 100 index. Absolute return funds did struggle a little bit by comparison to perhaps some of the structured product maturities that happened during that year. So broadly, the average return, I think, from the absolute return sector during 2015 was something around about 4%, just over 4% across the piece on average. Whereas the average from the structured product maturities over that particular year were much nearer to 9%.
Mm-hmm. And so, Jason, obviously, you guys at De Facto do a lot of research into these products. Have you seen a big pickup of flows into the absolute return space?
For sure, like absolute return, it's been driven basically by pension freedoms and the need for people to generate an income and a return in retirement and do that in a risk-controlled manner. Absolute return funds fit within that. They're UCITS vehicles, not complex, so it's easier for advisors to recommend those funds as opposed to some of the structured products where maybe it's less of a core holding. So, and also the issues around transparency as well. Costs are easier to assess on an absolute return fund Whereas with the structured products, maybe not so clear or harder to compare like with like. So yeah, we're seeing a lot more demand on the absolute return side, basically.
And to Colin's point of structured products being able to deliver perhaps more stable or better returns during some of those periods, is that something that you guys have also seen when you stack them up against absolute return funds?
Well, I think it's it's different. So with a structured product, obviously you're guaranteeing on your downside or limiting your loss. Whereas with an absolute return fund, it's not guaranteed. But the issue is you need to be prepared ahead of time. So, we're talking about volatility over the last 6 months. Essentially, a lot of those structured products are an underlying passive index with an option on top. But buying an option in a volatile market is actually really expensive. So you really need to be prepared ahead of time rather than, if you wait until things are already kicking off, you're kind of a bit too late. So yeah, I mean, that's, yeah.
Certainly, I would agree with that if it were a capital protected, 100% capital protected product, particularly a deposit-based product, for example, where you are buying a call on the market to buy the upside, if you like. With the capital at risk products, because they have the barriers in them, usually sort of 50 or 60% in the current marketplace at the moment, what we're doing is we're selling a put option into the market. So we are what we call selling volatility. So the net effect when volatility increases is that the proceeds of the sale of the put versus the purchasing of the call, you're getting more money from the sale of the put than you are having to spend in the call. So you're actually able to structure more upside for the client in volatile markets. Mm-hmm. So we're noticing that at the moment. We're actually doing some pricing, it's Wednesday today, isn't it? Today, ahead of the referendum tomorrow, and markets, as we all know, are all over the place. And the volatility in the FTSE has been spiking quite dramatically over the last couple of days and getting back to levels that we saw around August of last year when the market took its sort of lowest downturn.
I think the key thing with all of this is sort of the volatility is fine, but the client's ultimate question is where is my return coming from? So I think absolute return products have been quite good at sort of from a defensive nature holding value, but maybe not so good in generating positive returns, whereas the structured products have worked well in a flat market and some of the defensive products have actually kicked out and generated a positive return in a falling market as well. So we're looking for what are those investments that can generate a positive return when markets are going sideways, and I think that's where they've done well.
Isn't the question actually, will I achieve my objectives rather than will I get a positive return? Obviously, a positive return will help and lead to objectives being achieved, but we don't invest in a 12-month bracket, do we? Yeah. So volatility, part of your skill as a planner should be to say, I mean, you made the point earlier, markets have been volatile, they will continue to be volatile. Actually, maybe we don't need structured products or absolute return funds or anything at all other than just well-diversified portfolios to achieve, in the long term, the outcomes that you need to achieve your life goals.
Of course, absolutely. I mean, if you don't need a positive return, then you just leave your money in the building society or the bank. So there's no need to take any risk at all. So yeah, absolutely.
But one doesn't necessarily need the other. Just because you need a positive return doesn't mean you need to go down the route of a structured product or an absolute return fund.
Of course, but I think as part of a diverse portfolio, you need to be protecting the assets, but looking for the opportunities to generate a positive return as well. And I absolutely take your point. As a financial planner, you're looking at what are those long-term objectives, what's the return that you need from your portfolio, not from each fund, and then building a portfolio that's generate that positive return, but protecting your assets in the best way possible. So absolutely, but very few clients really are looking for a zero return or 1-2%. Most people are looking for a positive.
Yeah, I'm not saying that people will want a negative return or a zero return. More commonly, people might want a return above inflation. And actually, if you're looking at structured products, they don't necessarily give you that level of security that's what we're going to achieve. If you're tied in for, say, 5 years and inflation runs rampant, just because you're getting 6-7% potential upside in the FTSE on an annualised basis, doesn't actually give you the confidence that you're going to achieve your objectives over that period.
Okay. So in that scenario, so if you're looking for a return in excess of inflation, where would you go?
I think a well-diversified multi-asset portfolio. Combination of equities, bonds, it's Markovich, basic
but does that work?
Theory. Well, it has worked. Will it continue to work?
Backward looking, it's worked. Does it
Yeah.
work now?
It may do. The theory would suggest it will do, but there's no guarantee that a structured product will work.
There's no guarantee with anything.
Or an absolute return fund will work. With any investment, there's an element of faith. Paul Lewis, for example, has published this data, 20 years, that basically says you'd be better off in cash if you were in the FTSE.
Yep.
That is backward looking. Does it mean we're going to put all our clients in cash? Probably not.
I think for me, the point you make is relevant in as much as structured products are sort of a fixed term and defined outcome product. So you know what you're going to get or you're not going to get from the outset, and it's up to the advisor and or the client to decide together whether or not the payoff that is on the table, if you like, is going to perhaps weather any particular storm, whether it be your thoughts on where the equity markets are going or inflation or whatever it happens to be. And if the answer is, well, yes, I think I am going to get the payoff required to deliver the return I'll be looking for in that market, then that's when structured products can be very, very useful because you know pretty much what you're likely to get or not. I mean, they are, literally sort of on-off type of situations.
Well, I think there is we should come back to this modern portfolio theory because it's sort of the concept that equities and bonds act in a converse way, not negatively correlated, and I think that's been proven not to work. So people are concerned about equities because of all the risk that's out there at the moment. People are worried about bonds because of interest rate risk. You can't invest in cash unless you've got enough, so you're going to get zero return, not inflation. So it's kind of like there's your modern portfolio but is it going to generate a positive return? And I think the point you're saying, if we take the view, maybe we are conservative, that markets might be flat or actually decrease, can we use a structured product to actually generate a positive return as part of that diverse portfolio? And I think the answer is yes.
I think, from a client's perspective, some of the structured products work well for short-term protection. So if a client into accumulation, they want a relative certainty over their cash flow over the next 1 to 3 years, and they can't afford any investment risk. So therefore, having some sort of guarantee type structure around that helps. But beyond that, I think for the long term, the best protection against your portfolio having a shortfall is basically generating a return. And the ways to do that are via, multi-strategy, diversified portfolios, which these days falls within the absolute return.
Well, that's
sector.
one of an option on multi-asset. You don't need to look to absolute return funds to use a multi-asset strategy.
Multi-assets can be run as absolute return funds as
yeah,
well.
But just by saying, someone, if we're talking either or, with structured products in one camp and multi-asset in the other, and multi-asset covers a whole range from absolute return funds with profit funds, conventional managed funds, building sector-based strategies that ignore, the arbitrage and hedge type stuff of absolute, then the point is you talk about pension freedoms, but you'd like to think most people are investing for their lifetime. That's the goal. So we're talking a 65-year-old should be planning 3 decades hence.
Oh, yeah.
So when you're looking at a 5-year structured product, the fact that you can, with a degree of certainty, say, I know the outcome of this in 5 years' time, in most cases, particularly retirement, which is what I principally deal with, is irrelevant.
It's not irrelevant because clearly, as part of the overall financial planning process, you're going to be reviewing your client on a yearly basis or probably more frequently than that. So once it's done its job, or even if it hasn't done its job after the first period, then you can reassess at that point. It doesn't necessarily mean you have to go back into another structured product. They can go back into a wider portfolio, can sit in cash or whatever it happens to be, and you can make a decision at that time.
But the reason that you'd select a structured product in the first place would be an emotional reason. Well, there's nothing wrong with an emotional reason, but equally as well, you can manage the emotions of downside through counselling your client in the right way to not always expect that the investment will go up.
So surely wouldn't it not be better, though, if you had a product that said, I'm going to deliver you 7 or 8% per annum, and it delivers that 7 or 8% per annum. If the rest of the portfolio delivered, say, 2 or 3, then by comparison, they'll be very happy with that. If the portfolio delivered 9 or 10, then they'll be very happy with that. This has still done its job.
You can't say that a structured product will generate 7 or 8. It might. And depending on how it's structured, it will be 7 or 8, it might be 0, or it could be anywhere in between. Or actually, it could be that there's some downside if it's of that nature. So either way, there is going to be a good outcome and a bad outcome. And obviously, the point of stochastic modelling and that sort of thing is whether you're investing in a structured product that says there's your downside, there's your upside, and subject to the guarantee underwritten by X, that's what you'll get. A stochastic model would say, within these tolerances, we're pretty confident you're going to get that. That's a mean, that's your pretty bad, unlikely to be exceeded, but could happen. And that's your good, again, could be exceeded, but that to me is adequate. It's more transparent and it's probably lower cost than structured products, and would solve most people's long-term planning objectives.
Okay, so the sorts of figures that I see being, shall we say, publicised by risk management companies, asset managers and so on, as regards to where they feel the returns from different asset classes coming from, would indicate that, say, equities would deliver you, with inflation and so on and so forth, something in the region of around 7.5% to 8%, perhaps 9% if it's an emerging market, and so on. Obviously fixed interest around 4 to 5, and properties sort of 6 to 7, and so on and so on and so on. And then you take that and you superimpose that, if you like, onto the portfolio of the assets you put together for the client, and that will give you a number that it's supposed to deliver on a sort of stochastic basis. And if that number is perhaps 6 or 7% for the portfolio, then that's why that portfolio has been put together for that client, because that meets their risk criteria, it perhaps meets their financial goal, aspirations, and so on. I'm not saying to switch all of that away and put it all into a structured product or an absolute return fund. What I'm saying is a structured product can do exactly that. The only difference is that you will get the return or you won't get the return. Depending on the type of product you buy, you can have what we call participation rate products, where you'll get a percentage of the index, sometimes a geared percentage of the index. So that those can be used as not necessarily a complete alternative to equity, but an alternative source of equity return. Now, if the market doesn't do what we hope to from the outset in 5 or 6 years' time, then with a lot of structured products, you're not actually asking them to for the markets to rise at all in order to get your return. In fact, some of them, and the more popular ones that we've, should we say, been seeing being bought at the moment, are the defensive type strategies. Right. So they actually allow the market to fall, and you'll still make a positive return, which is, as Anthony was saying earlier. So you kind of trying to increase your probabilities overall of making the return that you agree with the client in the first place. I think
increase is probably putting a change. It might be a better way, because the whole point of it. Right, if I'm saying to a client, you need to have 10% in UK equities, and I substitute those UK equities with a FTSE structured product, then the nature of that is I have massively restricted the outcomes, because by its nature, over a 5-year period, the FTSE could be, on average, might be up 7% per annum, but it could double, it could be down.
But isn't the point with that you use it in conjunction? You use the UK equity exposure as a fund or a tracker, and then you use the structured product as a standalone investment as part of that portfolio. That's another one. We're talking about 2 different ways of using it. Yeah. I mean, the answer is how are you going to use it? But that's the second question. So the first question is, should you use it at all? And my view would tend to be, in those examples, we're talking about the long-term financial planning clients who are at point of retirement, who are planning decades hence. 12-month volatility is irrelevant, and just because I can guarantee an outcome in 5 years, largely irrelevant as well.
I mean, I think I agree with that point. I think there's a tendency with some of the structured products to give the client what they want and not necessarily provide the sort of guidance for the long term. So, a client might be risk averse, and therefore you think, we've got to guarantee that they won't make a loss over the next 3 years or something, and then they'll end up overpaying for that insurance. Whereas really, like you're saying, they need to be looking, decades.
Well, there's no coincidence in my mind that a big proportion of the structured products sold in this country are with banks. Because you haven't got to have that discussion with client. You haven't got to have a financial plan. You haven't got to go down the route of there are good outcomes, there's bad outcomes. You basically just say, I can guarantee you won't lose your money.
That's actually not the case anymore, I'm afraid.
A big proportion are not
Yeah.
sold by the banks?
Correct.
You think a small proportion are sold by the banks?
Yes, the biggest proportion now sold by intermediaries.
I'm actually interested in the discussions with clients that you have. So obviously with equities and bonds, they're quite easy to explain to clients, they can understand them.
Yeah.
With structured products and with absolute return funds, you're looking at much more complex structures. So how do those conversations with clients go, and how do you explain that and that they fully understand how they work?
I think there are a range of structured products, and some of them are much more simple to understand than some of them are incredibly complex. So in terms of what we do at First Wealth, we use probably everything that's a sort of one index, look at a kick out, the 50% barrier. So we try to use a consistent product in terms of what we're doing, one that we feel that we can explain to the client. But coming back to the point that we were talking about earlier on, is that the theory is great, that if you invest for 30 years, in theory, there's a researcher says you put everything in equities, and that's probably going to lead to a longer term good outcome for the client. But that's the theory. Now, the reality is, if you go through what we just come through in January, a lot of volatility, and the client comes in and says, right, how are things doing? And we say, well, we're down 10%, plus you're taking your income out. That gives the client a nervous reaction to that, what's going on. And I think the danger with all the theory is that they don't just remain invested. They might want to sit on the fence, take some of the money out. So I think structured products have the positive in almost validating what you're doing. So we can say, right, the portfolio, the general investment account with the shares and with the bonds, okay, it's had a flat period or slightly down, but the structured products we've had have generated a kick out of 7% over the last couple of years. So from a client's perspective, we've got parts that are working and validating the portfolio that we're doing, and then it sort of takes the heat away from the portfolio, which I agree with you, over time should generate those positive returns. But we just look for essentially a bag of investments. So you say, right, that's working at the moment, that's not working. So if a client's looking to generate or take the income, say, well, there's a positive return, let's put some of that into cash, that can pay the next income, rather than an asset pool of having a difficult time. So I think it's just trying to get a range of assets that react differently in different market conditions. And we feel strongly that the structures will do that.
So one of the questions that we've had in from Twitter and from the audience is talking about dividends. So the FTSE links that you guys have don't reflect dividends. So how do structured products allow for reinvested dividends? How do they compete against that?
Yeah, you're right. The index that structured product, or the indices that structured products use, are the price-only indices. So the FTSE 100, for example, is a price-only index. It's only the total return version of it that includes the dividends. So we're not necessarily, one of the misconceptions in the earlier days of working with Investec was, and when talking to advisors, was that Investec are actually keeping the dividends or keeping the excess returns that we're making if the market delivers 10% and we're only paying 7%. And that just simply isn't the case. You pay, the price you pay in the build is for the level of return that the product is going to give you, or give the client, I should say. And anything above that is not priced in. Therefore, it would be, say, cheaper to build a product that would pay a 5% return. If the market produced 10%, then somebody else somewhere else is making that excess above the 5%. But we've paid for effectively making a 5% return. In terms of, yes, structured products won't include dividends. So it is the price only. All you've got to look at really is the coupon available from a FTSE 100 index product, and let's say that coupon was 7 or 8%, do you think that's enough to compensate you for not receiving dividends, given that the stochastic models for equity returns going forward tend to throw up 7% or thereabouts as a return that you're going to get in totality, including your dividends. So are we out of kilter? I don't think we are. Do we include dividends? No, we don't. Are you getting compensated for that? Yes, you are, I think, in my opinion.
It doesn't, it will just make it very hard to compare.
It does.
Among different structured products. I mean, this is the tricky part. You have different kind of exercise prices, or for whatever the level of the FTSE is, different protection on your capital. So. And then for an advisor to assess the suitability, amongst different products.
I actually think this is one thing, but structured products are actually simpler than absolute return funds. You made the comment about absolute return funds are simpler. don't agree. I mean
I would say so. The structured products are simple in terms of, okay, you've got an underlying index, but then you have these various options on there which you have to compare one against the other.
And you're comparing apples. So that, but at least you know. To a point, you might want to look under the bonnet, see what's going on, but at least you know it will do what it says on the tin. Is a 70% upside in the FTSE better than 100% if that's got a cap of 35 and that's got a cap of 20? I don't know. I mean, it all depends on your view on the out, and there are a lot of variables going on.
This is another sort of theme with de facto that we have at the moment, is that those kind of decisions should be made by a fund manager. Hence why having these kind of derivative strategies should be run by a fund manager. If there's an absolute return fund that's got a 1 year horizon, which that's like 30% of the sector, then that would make sense as well. So rather than having an advisor which trying to make these decisions, which like we're sat here without any sort of maths.
If you're comparing it with absolute return, the other side of the coin is when you recommend an absolute return fund, you need to know what's going on underneath. How do I explain to a client that this guy here, he's got a put option on the US dollar versus Brazilian real, that's a great idea. I've got no idea. I've got no concept of how.
That's a level that advisors shouldn't really get involved with. I mean, basically,
but if you can't explain it to your client, how can you recommend it? I mean, at least a structured product, I can say that's how it will work under these circumstances.
How as an advisor do you explain the difference between like a growth equity fund versus a value fund? I mean, if you actually look at how a fund manager works and he picks stocks,
it's simpler. Than recommending explain how an absolute return fund works.
And I agree with you. I think these sort of absolute products have evolved. So traditionally, it might be a multi-asset sort of bond, a bit of equity, fairly easy to understand. But if you look beneath the bonnet in some of the products now, there's a lot of derivatives.
Well,
and a lot of
they're
options.
hedge funds. I mean, you say they're UCITS, but they are basically retail hedge funds. There's reasons why you don't recommend hedge funds to retail investors.
They do have risk limits in terms of what leverage they can use, and they're not pure hedge funds, to be honest with you. So
I think all this will be made slightly easier particularly for the advisor community and for the end clients when we see the changes that are being made in the regulation. Now, there's something unfortunately I have to get involved with quite a lot in Investec Structured Products. And the pieces of legislation, I think, which will genuinely help this debate, if you like, around what is it am I buying, how much is it actually costing me, and how do I compare it against all the other things in the market, are the fact that as of January, this coming January, insurance-based investment products, so whatever they happen to be, multi-asset portfolios and so on, and structured products will have to be issued with a key investor document in a very, very similar format to the key investor document with funds, exactly. In fact, the funds KID document will be updated to the slightly more sort of stringent, if you like, PRIPS legislation for 2019, so that's another year away.
Do you think it'll make it easier to understand?
What it will do, or what it should do, I think what the aim of it is...
What it should do, yeah.
Yeah, we'll come back to the real world in a moment. What it should do is allow you two, principally, to take a structured product, to take an insurance-based investment, to take a fund-based investment, and at last start to compare on a like-for-like basis with costs, the risk rating and so on. For me, the risk rating piece is quite interesting for a structured product, because clearly one of the biggest issues that structured products will always have, if you like, in the minds of anybody who looks at them, is you're buying market risk, but you're also buying credit risk. You're buying those two risks, and I understand market risk because I'm much more used to that, and there's plenty of models out there that show that. I don't understand credit risk. I don't understand what the impact of having a AA rated bank versus a BBB rated bank and all those gradients in between actually equates to, and whether or not I'm being paid for that.
And that assumes also that those ratings are right in the first place.
Well, yeah, that's another subject entirely. Don't get me started on that one. But what will happen within the PRIPS KID for structured products will be that we'll be able to now see the combination of the market risk and the credit risk together in that 1 to 7 SRRI scale. So you will be able to look at a structured product and a multi-asset fund or a single asset fund, and say, okay, well, these are both 4s. Right, so they're both saying that they're the same risk. So let's look at some of the other factors now, and then make your decision from there on.
Excellent. That's actually all we've got time for today. So I appreciate all of you joining us. So thanks a lot to all of our panellists. An on-demand version of this debate will be available shortly. And thanks very much for watching.